This video reviews the mechanics of depreciation. The Tax Cuts and Jobs Act drastically modified provisions in the code dealing with depreciation and made many of the depreciation provisions obsolete, at least for the moment. Because several of the new provisions are temporary and you might be dealing with pre-Tax Cuts and Jobs Act law, we have decided to provide a brief introduction to depreciation generally and then an explanation of how the current Tax Cut and Jobs Act provisions work. The basic premise is that when you purchase an asset, you merely have transformed one asset, cash, into another asset, the thing you purchased. At the moment of purchase, the business has no change in its economic value and no real expense. Before the purchase, the business had X amount of assets, and after the purchase, it had X amount of assets. Because there has been no change in value and no real cost to the business, the tax code did not allow a deduction for the full value of the asset when it was purchased. Instead, Section 167 allows a deduction for exhaustion, wear and tear, and for the obsolescence of property used in a trade or business or held for the production of income. For tangible property, Section 168 provides the mechanics for depreciation and allows the depreciation of an asset over a period of years. So for example, if a business purchases a delivery vehicle, the vehicle is not an immediate expense, but instead the cost of the vehicle is depreciated over a number of years. In our example, 5 years. There are two types of depreciation methods. Straight line depreciation, where you depreciate ratably over the recovery period, and accelerated depreciation, which allows you to take more depreciation in earlier years. The most common accelerated method is the 200% method, or double declining balance method. With the double declining balance method, you take the amount that would have been allowed under straight line method and you multiply it by 200%, or double it. In the first year, you get double the amount you would have gotten under the straight line method. For example, if you have a tractor worth $50,000 with a recovery period of 5 years, you would depreciate $10,000 a year under the straight line method. Under the double declining balance method, you would receive $20,000 in the first year. Unfortunately, it's not that easy. Because an asset is not usually placed in service in the beginning of the year, the code creates conventions for determining when an asset is placed in service. The half-year convention is the default and applies to most assets. It treats property as if it were placed in service or disposed of at the midpoint of the taxable year, thus the half-year convention. There is also a mid-month convention used for real estate and a mid-quarter convention used when a taxpayer places a lot of property in service in the last quarter. Because of the half-year convention, taxpayer only receives half a year of depreciation in the first year. Based on the time value of money, taxpayers generally want to accelerate the opportunity to obtain a tax deduction. There is an argument that allowing immediate expensing instead of requiring a taxpayer to depreciate an asset creates a more simplified tax code and promotes economic growth and business activity. Congress has traditionally used two methods to provide for more immediate deduction of an asset. Congress has been especially sympathetic to small businesses, arguing that depreciation may be overly complicated or requiring a business to spread the cost of an asset over a number of years would be an economic hardship for a small business. Under Section 179, Congress provided that a taxpayer could elect to expense assets instead of depreciating them. Under Section 179, a taxpayer can expense up to $1 million. If the total amount of qualifying property purchased in any year exceeds $2.5 million, the expensing amount is decreased dollar for dollar. Thus, if a taxpayer puts $2.6 million of property in service, the taxpayer can expense $900,000 of the property. The $1 million amount minus the $100,000 phase-out amount. The amounts are adjusted for inflation. Congress has also provided for a more immediate deduction of an asset by providing for bonus depreciation. Section 168K provides for bonus depreciation for any tangible property with a depreciable life of 20 years or shorter. Bonus depreciation has been set at different levels over the years, but for the first time, the Tax Cuts and Jobs Act provides for 100% bonus depreciation. Yes, I said 100%. Now I know what you're thinking. Why did you make me watch this video if 100% of an asset can be depreciated in the first year? The reason is because this provision doesn't apply to assets with a class life greater than 20 years, for example, real estate, and the 100% bonus depreciation is phased out between 2023 and 2026. Technically, you apply the Section 179 deduction first, then the 168K bonus depreciation, and then you depreciate the remaining amount over the period of years provided in the code. In the near term, this is not much of an issue because 168K will allow 100% of the asset to be deducted in the first year. The Tax Cuts and Jobs Act did not drastically change depreciation for residential real estate. Section 179 and 168K do not apply to real estate. Residential real estate is depreciated over 27.5 years, and commercial property is depreciated over 39 years. In addition, the straight line method applies to residential real estate. Also remember that real estate is treated as if it is placed in service in the middle of the month in which the property is placed in service. So if the property is placed in service on January 10th, it will be treated as if it were placed in service in the middle of January. For now, the Tax Cut and Jobs Act has made a very complicated area, depreciation, fairly easy. If the property is tangible property, the property will be entitled to treatment under 168K, and all of the property will be immediately deductible. Technically, the property is not fully expensed, but instead, you are entitled to bonus depreciation. In this case, these are just words. As long as 168K applies, a taxpayer will be able to immediately deduct all of the capital expenditures in the first year. If you are still practicing tax in 2023, you will need to revisit this issue.